Hi folks, I'm Phil Newton, developer of Trading Strategies, which provides real-time training and education. This video shows some highlights from my live training sessions. Hello folks, welcome back. This short video is in response to an email question. Let me just read out the comments. Right, okay, so one quick question. When the market is in a downtrend, price has gone through lower lows, do you normally wait for a candlestick to help confirm your strategy? For example, an engulfing bearish candle or any bearish candle just to help you decide that price is in a downtrend? Thanks very much, Phil. No rush for the answer. Right, okay, so what is the bias change? Well, first of all, let's just think about what is a bias change. When price, or what is the trend? The trend is when price is making higher highs, higher lows, it's going up. When price is making lower lows, lower highs, it's going down. So what we're looking at the bias change is the first point in time that price is making either higher highs, higher lows, or lower highs, lower lows. Now the points of the chart that we're looking at the moment, I've already got everything marked up just from my own regular analysis. But the points of the chart that we're looking at, what we're going to look at is two different types of bias change. And it very simply just the difference between two different philosophies, difference between Elliott wave and Dow theory. Now the first one we're going to look at is basically the Dow theory style of bias change. And Dow theory basically says on the breach of a previous swing low, trade the first pullback. Elliott wave theory is looking for the failure to make a new high, then trade the first pullback. So let's take a look at what those actually look like. And it's still the first point in time, remember, when price is making lower lows, lower highs. So first of all we're doing is we're marking off the swing highs and swing lows. So at this point in the chart, price is going up, as we can see. Price is making, if I just mark on here, price is making higher highs, higher swing lows, and higher highs. So we've got a swing high. Swing high, remember, is a bar preceded and succeeded by lower bar highs. So this bar here, that's the highest point of the three bar combination. It's a bar preceded and succeeded by lower individual bar highs. So we've got this point of the chart here. So price is making higher highs, higher lows, and what we can see is that price has breached the previous swing low here. So that's the previous swing low. So we've got the breach of a previous swing low. So now what we're looking for is a lower swing low. So that lower swing low develops on this next bar. So now what we have is this bar here. That's the lowest point of the movement. We've got a bar preceded and succeeded by higher bar lows. So that is the swing low. So we've got, say what you see on the chart, higher low, higher high, lower low. So if price goes below this point here, this lower swing low, we will have a new downtrend in force, because this is the first point in time that price is making lower lows. Now at this point as well, the lower high is developing. We don't know where that's going to be. It could be 2, 3, 4 bars later. It could happen on this next bar. It could just be an inside bar. We don't know where that is. But price will be making lower swing lows and ultimately lower highs when price goes below this swing low. So if price goes below this swing low, price is in a new downtrend. So as it turns out, price continues to rally. 1 bar, 2 bars. We get another swing high. There's the swing high that's developed. So in real time, we don't know where that swing high is going to be. This swing high that's developed. Price is retraced. So now what we have is we've got higher high, lower low, and that lower high is developing. So price has moved below that swing low, and it's now confirmed the downtrend, a new downtrend, at this point of the chart. And that's one version of the bias change. On the breach of a previous swing low, we can basically trade the first pullback. What is a pullback? It's a retracement in price. There's the pullback. That's created the lower swing high, and price now is in a downtrend. So price in a downtrend. Let's just skip through the chart. I want to go to a different variation of the bias change. Right, so we've got the same thing over here. Same thing over here. Right, so this point of the chart, so let's just take a look at the a different variation of the bias change. Price is in an uptrend at this point of the chart, and obviously it's the reverse conditions for a long directional bias change. Obviously we're just looking at short directional bias changes, because at the moment price is basically long term been going down. So again, just say what we see on the chart. Price at this point is making higher high, higher low, higher high, another higher high, higher low, lower high, and price is now going down. So we've got, say what you see on the chart, higher swing high, higher swing low, lower swing high, and now price has breached that previous swing low. So when price breaches that previous swing low, we're looking for the first pullback. So we've got high, higher low, lower high, and now looking for the lower swing low to create the entry. There's the lower swing low. So we've got high, higher low, lower high, lower swing low. Price is now going to be in a downtrend below 160. That's the first point in time that price is making lower highs, lower lows. And again, just another variation of the same thing. Price continues to retrace, and you can see that continued retracement. So when price goes below 160, which it does do here, price is now in a newly established downtrend through that last swing low. So just to recap, high swing high, higher low, lower high, lower low sequence. So when price goes through that last lower low, price is in a downtrend. So to answer the question, am I looking for any particular pattern, bar pattern, to indicate a downtrend or to enter into a position? No, I'm not. This is very simply the pattern I'm looking for. So this is your 1, 2, 3 pattern, and there's the pullback. It's a 1, 2, 3 pullback, 1, 2, 3 Ross hook, multi-point reversal. Trading the first pullback after the failure to make a new high. Again, all different names for exactly the same pattern. So even though this is on a 240-minute time frame, this is the same pattern that I'll use to enter into the market on a lower time frame. So if this pattern that we're looking at, this is the reversal pattern. It's a bias change. I tend to refer it as a bias change because this is when the bias changes. So if this pattern develops at a level that I'm looking to take a trade on, for example, if we were looking to take that trade on there at this point, let's just say we were using fib retracement. So if I was looking for a short trade, and price has got up to the 61% retracements, price moves up to that level, I'll be looking for price to rally and make the lower high, lower low sequence. There's the entry. That's this point on the chart there. As soon as price goes below that last swing low, below this swing low here, your entry will be below that last swing low. So that's the entry pattern. I'm not looking for a particular bar to confirm it. The pattern itself is confirmation of a new directional bias change. That's it, folks. That's the bias change. No particular engulfing patterns or bearish bar patterns or even bullish bar patterns for a long trade. As soon as price goes through that level, that last swing low in the pattern, then a new downtrend is in force. That's what we can see.